Good morning or good afternoon. This is Charlie McQueen, President of McQueen Financial Advisors. Welcome to our webinar here in March, MSR 101. We're excited to have everyone join us. Thank you for giving us your time on this actually wonderfully beautiful day here in Michigan, nearly 70 degrees and sunny, which is probably not what you'd expect in late March. With me today, I have two wonderful advisors. We have Jim Craven, Vice President and Senior Consultant. Jim runs our CECL operations, has been a big part of our MSR operations, a lot of modeling work, and been a great team member with us for many years. Jim has a great diversified background. We also have Danielle Atisha, one of our financial analysts. Danielle has been really doing awesome work in the MSR area, along with the valuations and work in CECL and fair value reporting. Really great to have Danielle here to share her knowledge with us today. So thank you, Jim and Danielle, for joining us today. As we go forward, feel free to ask any questions. There's in the bottom of the screen or top of your screen, if you move your cursor around, sometimes it'll pop open. There's a Q&A box. Feel free to drop a question in there, and we'll answer it as we go or at the end, whatever is the most appropriate time for the question. Today's webinar is also going to be recorded. Please reach out to your advisor, your McQueen Financial Advisor, if you'd like a copy of it, and we'll get it over to you. It'll also be available on our YouTube channel. If you need to get directions on how to get there, please reach out to your advisor also. So with that, we have a great agenda today. We're going to kick off with an economic update, and then from there, we're going to go into the MSR world, the basics, what is an MSR and more. We're going to get into MSR, or mortgage servicing rights reporting. What to do with your report, one of my favorite topics. Now that we have a report, what should we do with it? Here at McQueen, we work very hard to provide our clients with a great advice, but then a great report to go along with that great advice, and then some direction on what to do. Then we'll wrap up the conversation today with question and answer time. So again, thank you for joining us. We're excited to spend some time today, and we're going to kick things off with our economic update. So one of the things here at McQueen Financial, we have a regular ongoing battle over interest rates. And I have called this a very low yielding yield curve. And Craig Cecilia, our Chief Investment Officer, continues to call it a steep, wonderful yield curve. And I finally threw in the towel, and I agree with him today. We've seen yields come up substantially, especially on the long end of the curve. And we actually have a very nice looking yield curve. What is interesting here, if we think about this, the yield curve compared back to 2012 to today is effectively the same as the slide shows. It's really amazingly close. And what's really interesting here to think about this, today cash yields roughly 10 basis points. Our investment advisory team here at McQueen Financial is buying yields over 120. And I'm going to use 120 for simple math, because if we buy an investment today, we are going to receive 1 year of cash income in 1 month. Instead of getting 10 basis points over a year, we're going to get about 10 basis points a month. So yields have substantially improved. One may say this might be a little bit of a gift, how much yields have come up, but we're at a great spot now for deploying cash, and really a bit of, I think, a gift where rates have drifted up, and now I do expect they might drift down a little bit as we continue to talk about inflation and an economy and COVID. So again, wonderful spot. We did have some of the short-term treasuries bounce with negative yields recently. We still have a very low yield curve here. Looking now at the next slide, where we go back over the long term, those of you that know me, one of my absolute favorite graphs, because it really focuses on a picture of the yield curve by depicting three major topics that affect us. One is the Fed funds rate. Two is the 2-year Treasury. The Fed funds rate is the red dotted line. The 2-year Treasury is the blue line. And the black dotted line is the 10-year Treasury. And so as you see here, we're headed back to somewhat of normal shaped yield curve. And that's happened very quickly here in the past couple weeks. And normally when we go with these steep increases in yield, we tend to top off and maybe come down a little bit. So I do think we have a bit of an opportunity today. But we have continued to see the short-term yields, the 2-year Treasury, stay extremely low at 16 basis points. So very low yields still, but a much better shaped yield curve. So from here, one of the things that we're going to talk a bit about in any economic presentation is thinking about inflation. Now, why are we having so many conversations about inflation? Well, we're discussing inflation at length because there's a fear of inflation in the market today. The fear that inflation starts with a lot of conversations around housing values. And if we look at the housing market, we've seen home prices come up substantially. And one of the biggest reasons why we've seen home prices come up substantially is a supply and demand problem. Now, this graph does show that we're above values where we were at the peak back in 2005 in home values, but one will tell you, would think that maybe 15 years later, it's not bad that we have a little bit of home value inflation. Now, the next slide really goes into the detail to me that shows the difference here. What we're seeing is a volume of home sales of existing or used homes, as I like to call them, which is off the right-hand side chart here. The blue line is up to about 6.6 million. We're not to the high point, but we're getting close to the high point back in 2005. The thing that's interesting is new home sales. New home sales have never recovered. Now, they've gotten a heck of a lot better here in the past couple of years, but we were up to almost 2 million annualized new home sales at the peak. And we haven't been anywhere close to that. We've been in the 600,000, if not even down to the 400,000 range for a long time. And what ends up happening is we're not getting enough homes built now to keep up with supply or demand. We don't have enough supply to keep up with demand. And so the home value increases we've seen have been based off of supply and demand and cheapness of debt, which is very different than what happened in the last housing crisis. The last housing crisis saw multiple people owning many houses or condos for speculation. And what we're having today is people buying homes to live in, not people buying homes to speculate on price increase. I'm sure there's some, but nothing near there was before. So here, is this inflationary? Now, one would argue that it's not inflationary. This is just a supply and demand issue. And also you start to look at the cost of rent, and then the inflation numbers are included in a rent component index, and rents are probably going to be coming down as more and more people have decided they want to live in houses versus apartments at this point. So definitely an interesting world. I don't see inflation here. Now we look at our next slide. One of the things that really focuses and shows me potential for inflation is the consumer and the consumer's appetite to spend. And overall, the consumer is 70% of our economy. And here, the consumer confidence, while it rebounded from its lows we had with the start of the coronavirus world a year ago, a little over a year ago, it's hard to say that. We're seeing it still come up a little bit, but not as much as one would expect. But the key to take from here is long-term forward expectations. The red dotted line are still pretty darn good. And as we come out of this environment, this lockdown, I do expect we're going to see people start to spend money. Now, our next slide really adds to something that's really interesting, is really what is happening with all the dollars coming into our world. Well, this is the beginning of what we call our M2 growth conversation. The money supply in the United States in the past year has grown close to 5 years worth of money supply. And that's adding in the latest stimulus package that's rolling out right now. So basically, for the term of the pandemic now, 1 year, we're close to 5 years worth of cash growth. That growth has come into all of our financial institutions on the call here, all of people's checking accounts. It's gone into their deposits. You're seeing this happen, and it's truly, truly a unique, amazing time. And what that's done is put a lot of extra money in people's hands, which causes them not to be delinquent. Home equity loans, nearly all-time lows of delinquency. Mortgage loans, all-time lows of delinquency. What else? We're seeing credit cards near all-time lows of delinquency, and credit card loans paying off because of the amount of excess cash. Auto loans, we did see a peak back up here, and it seems to be coming back down. We think that had a bit to do with people being a bit opportunistic of not paying loans, but also some of the duration. We saw some really long car loans back 4 or 5 years ago, which that may be coming back with some negative amortization to be a problem. Then student loans. There's a lot of conversations. Part of the stimulus package is to forgive parts of student loans. And we're seeing that cause delinquency to decline. And also, you don't have to really pay your student loans today. One may joke, there's so many programs to hold off that we're seeing delinquency decline. So with that, the consumer is doing really well. In our next slide, highlights this cash growth again. And what's happened here is disposable income, the green line, which has been on this consistent nice rise, spiked substantially with the stimulus checks that came out. Now, this graph does not include the last round of stimulus checks. And so we're going to see once again, when this graph gets updated, a direct spike up of household disposable income coming in. And so what that's done is it's causing people to have more cash, and debt levels actually, which are relatively similar growth because people are going out and borrowing more money for houses, for example, but the ability to pay that debt has greatly improved. Now people have more cash and they have more income, so their debt to disposable income graph, the blue line, is improving. But on top of that, the cheapness of debt is really helping out. When you can go and borrow $250,000 for $1,000 a month, it really makes that number look better and better. So what we're seeing here is that consumers are in the best financial position they've been in, comparatively the same level of debt payments going back to the mid-90s. So the consumer is really in a good shape. And that's one of the reasons being that we do expect that we're going to see some pretty good economic activities as we come forward from this pandemic. Now the next slide is one that is making me not nervous, but one that has ramifications out of different things. Oil has been very well behaved for the past 4 years. We've been in the $60 range, $50, $60 range. We were back in the hundreds before that when there was a lot of talk of really getting rid of and more of a green agenda. Now we tend to be heading back more towards a green agenda in our elected officials. So that's going to push oil prices up a little bit. But here we see some spikes with supply and demand. But what I really take from this today is that the economy is recovering nicely. Even Google had a little indication out that people are actually traveling as much, if not more, than they did pre-pandemic when tracking cell phone data. And we're seeing that people are out driving and doing things. There's traffic jams again. So that utilization of oil is a good indication of economic activity. And we're predicting some pretty good economic growth this next year. We're talking about decent sized GDP numbers. 4, 5, 6, 7% GDP growth numbers are being predicted. And a lot of that makes sense for oil to continue to be a little bit more expensive because of supply and demand. We do have an interesting issue with a boat turned sideways in the Suez Canal that may cause, if that's not fixed in a relative quick basis, some more supply constraints, which could cause rates to go a little bit higher, or could cause oil to go a little bit higher, excuse me. So our next slide, which really goes back to the point that I started here with, is inflation. Inflation is low. There's going to be a ton of conversation about inflation and potentially inflation going higher. We had a number of Treasury and Secretary of Treasury and Powell speaking, and the comments were that they do expect inflation to turn up a little bit, but for it to be a very short-term inflation modification. And so here we still are running at the consumer price index 1.7, ex food and energy at 1.3. So energy and food prices are really the biggest increasers right now, or big increasers right now, excuse me. But the PCE, personal consumption or expenditure core index, at 1.5. This is a good indication that inflation is not here. Someday we will have inflation. We think it'll be short-term in nature, but that is driving, the fear of inflation is driving Treasury yields a little bit higher today. So going to the next chart, this is one of my other favorite charts here. And what we're looking at is bond yields and comparing 10-year Treasury yields around the world. And we in the United States are grouped with the rest of the normal countries, democracies all throughout there. So we have Japan, UK, Germany, and US. We're all in relative tight proximity, with the US traditionally being the highest yielding. And so we can see here that Germany still is at a negative yield. UK is still below 1%, and Japan is at 11 basis points. So it's not only the U.S. yields having to rise dramatically; it would have to take all these yields to rise dramatically to see much higher rates here. We do see the difference of China and Brazil, again, not really democracies, substantially higher, but this also gives credence that we should expect rates to stay relatively low for the foreseeable future, which is also something very important when we talk about mortgage servicing rights, 10-year Treasury and 30-year mortgage rates have a historical lock where they move together. And as we see yields come up, it is going to slow the production of mortgages. And if we would see rates come down, we'd see a spike in production of mortgages. But overall, we expect interest rates to remain relatively similar in this market. Maybe we're as high as 2% on the 10-year Treasury this year. I wouldn't expect any higher. But I also think we have the ability to test sub 1% yields based off of economic activity, based off of coronavirus activities, and where we go from there. So the next page goes into Fed funds rate. And this is something important because it's not only my viewpoint and the team here at McQueen Financial. As we look at interest rates, we also want to look at what the Fed says, and we also want to look at the betting in the interest rate market. Well, the targeted Fed funds rate currently is from 0 to 25 basis points. The implied rate is running right now around 7 basis points. And over a year from now, the implied rate is expected to be roughly 8 basis points. So the market does not believe interest rates are going anywhere in the short end of the yield curve. And we do expect that the 10-year Treasury, while it's up a bit now, it may go up a little bit more. It's probably to come back down. We're going to stay in a relatively low rate because of the uncertainty, because of continued activity of the coronavirus, and we'll see it as the economy rebounds. And with that, I do expect that the second half of 2021 and 2022 is going to be very similar to what we would go back to as the Roaring 20s. Now, we're joking around here. No one wants to see me in a flapper's outfit as we think back to the 20s, what happened. It was a celebration. The pandemic was done. People were out, and the economy boomed. We expect the same thing to happen here as we get into the summer of 2021 and into 2022 with great activities. So before we kick it off, there was a question I'll just quickly answer before I hand it off to Danielle here. Looking forward, do you believe that home values will drop and interest rates will increase? And I think that the question here really goes back to, as interest rates rise, it's more expensive to buy a house, and therefore home price increases are tougher. And if interest rates rise substantially, home values come down because of affordability. So I don't think we're going to see a substantial enough increase of interest rates to cause a home value decline. I think what is really going to be more of a basis of home value modification is going to be the cost of lumber and the availability of labor. Today, unemployment pays quite well. It's hard to find basic labor positions, get them filled. That combined with lumber prices are going to keep home prices at the levels that they're at for quite some time. So with that, I want to thank everyone for joining us, and I'm going to hand off the conversation to Danielle.
Thank you, Charlie. Good afternoon, everyone, or good morning, depending on your time zone, and thank you for joining us. My name is Danielle Atisha, and I'm an analyst at the Valuations Group here at McQueen, and today we're going to be discussing mortgage servicing rights. So first, we're going to cover the very basics of what is a mortgage servicing right asset and how is it created. Later on in the presentation, we will get into more detail in regards to how it is valued and the determining factors and assumptions of the valuation. So what is an MSR? A mortgage servicing right is created when a financial institution originates a mortgage and the loan is sold to Fannie Mae or Freddie Mac. The servicing rights are then retained by the institution to collect and distribute payments in exchange for a fee, and this creates a mortgage servicing right, which is considered a level 3 asset, and that means it must be valued. So since MSRs are considered a level 3 asset, the value cannot be determined using readily available sources. So this makes the asset pretty challenging to value, and it's also the most illiquid type of asset. So in order to value this, we must use an array of model inputs and assumptions. Now, when it comes to actually valuing the MSR, we use different criteria in order to come up with the value. So some of that criteria would be the loan type, for example. So is it a 10, 15, 20, or 30-year loan? What is the age of the loan, the size in terms of balance, the location, the prepayment speeds. as well as the discount rate. And we will get into this in a little bit more detail later on in the presentation. But first, I wanted to hand it over to Jim to discuss the model assumptions.
Thank you, Danielle. Yeah, there are several assumptions that go into the MSR model to help us derive and calculate the value. The biggest driver of MSR value is the prepay speed. So you can imagine this is a very important input. We will use Bloomberg as our primary source, but we also look at recent pool speeds because there has been so much volatility in the market with interest rates having gone down. Prepay speeds ramped up quite a bit, and there is a wide range of model inputs depending on the structure of an individual pool and so on. The discount rate, we do a public company survey, which Danielle is going to talk about in a few minutes, and that's one of our primary sources for this information. Currently, our discount rate within the model is 7.75%. There's a float rate on excess funds. We generally use the Fed funds effective rate, which is, as we know, almost zero. Then there's a cost to service, which is one of the key inputs. This is your cost to service loans might be very different than this model assumption, but we do use $8.50 per month per loan. There are some surveys out there. There's also some sub-servicer agreements that we can get our hands on to give us an idea of what's the appropriate model input for this. Servicing fee income comes right from our client. It's supplied in the file. Typically, these are 25 basis points, but we do have some outliers where some of our clients will send us a file and their servicing fee income might be as high as 40 basis points in some instances, but mostly they're 25 basis points. Then we also have a component for late fee income, and these are generally would mirror what you would charge to a delinquent borrower. So that's just a general overview of the assumptions that go into this. Some of these are observable, meaning that we can go to the public company survey that Danielle is going to talk about, and for the two on the top, we have some sense of what the market in general is using, but others we have to use a variety of different sources. So I'm going to turn it back over to Danielle to talk about MSR reporting.
Thank you, Jim. So now that we know and understand what an MSR is and the assumptions that go into the valuation, we're going to dive into the actual reporting method and show you McQueen's method. So this is a summary of one of our clients' mortgage servicing rights portfolios. And as you can see, we stratify the portfolio by loan type. So off to the left there, you will see 10, 15, 20, and 30-year tranches. And the reason that we value these loans differently is because, for example, the 30-year loans have different attributes such as prepay expectations and age in comparison to the 10-year loans. So if you look at the prepay CPR or the conditional prepayment rate, you can see that the 10-year pool has a much slower prepay speed of 9 CPR in comparison to the 30-year pool, which has a CPR of 16. This is the origination year summary schedule, which breaks down the MSR portfolio by year of origination. So looking at the unpaid principal balance, you'll notice that about 44% of the loans in this portfolio were originated in 2020, and that is where we experienced historically low interest rates. So during this time, borrowers had very little to no incentive to refinance these brand new loans at these hyper low interest rates. And since the main driver of MSR values is prepayment speeds, you will notice that the value for mortgages originated in 2020 is significantly higher than the rest of the pool at 124 basis points. If you also take a look at the prepay speeds, you'll see that the pool of loans originated in 2020 have an overall speed that is significantly slower than the rest of the portfolio at 7.5 CPR. Also, if you take a look at this, you'll see that every loan originated prior to 2020 has a higher gross borrower rate, and therefore they're eligible for refinance in today's low rate environment. So as mentioned, the main driver of MSR values are the prepay speeds, and that is based on the current rate environment. So this analysis within our report shows how the MSR portfolio would react to either an increase or a decrease in interest rates. So off to the left there, you'll see in the scenario that when the interest rates have decreased by 200 basis points, the MSR value has decreased as well. And then when interest rates decline, the prepay speeds increase due to the refinancing opportunity. So faster prepay speeds result in a lower value since borrowers are prepaying on their mortgages. And adverse on the right, when interest rates increase, prepay speeds will decline, resulting in a higher value since there is little incentive to refinance these loans. As I mentioned earlier, our MSR valuation report is broken down into different loan types such as 10, 15, 20, and 30 year. So throughout our report, we have a detailed schedule for each loan type, but here we're going to focus specifically on the 10-year page. Now, as you can see, the first few line items on this schedule carry the highest value due to the fact that a large amount of these loans were originated in 2020, which again is where we experienced that low rate environment. Now, if you take a look at the gross borrower rate for the loans in 2020, you can see that they're within the range of 2 to 2.5. And then off to the right, if you look at the prepay CPR for these same loans, you will also see that they have a significantly slower speed than the rest of the portfolio, which results in a higher value. Now, Jim, I'm going to pass it off to you to go over some of the takeaways.
Yeah, as a big picture statement, everybody is going to be interested in the value of the MSR pool, how the value has changed over time and so on. But I just wanted to mention a couple of items here that are a little bit out of the ordinary for the MSR reports and things that we might be able to do with the report. As we noticed on the other page, 44% of this pool was originated in 2020. A lot of these were probably refinanced mortgages. And that means that 56% of the pool is sort of in the money for refinance. And this could create a great opportunity for the holder of these MSRs. That is that you have at some point originated these loans. Some of them might be 10 years old or 5 years old, and nearly every one of them is eligible for refinance. It gives us the opportunity to reach out to borrowers, to offer them a refinance opportunity. After all, we don't own these loans, right? So if they get prepaid, it's not going to hurt our income, but it would definitely help our income to get some, fees off the origination process and some gain on sale of the mortgage loans. So we think this is a great opportunity, a great place to look where you can easily find those borrowers who are eligible and likely to refinance. We also have the opportunity for cross-sell. Meaning if you originated a loan for someone in the past, it's in your file, and if you can cross-reference this to your other activities, whether it be lending or deposit accounts or investments and whatnot, you might be able to, these are borrowers that know you, right, because you collect the payments, but there may be opportunities to, offer them other services if we can do some sort of a cross-analysis between the MSR pool and other services. Great opportunity there that's sort of right in front of us. I'm going to turn it back to Danielle for a comparison of the public companies.
Thank you, Jim. So in addition to our reporting, one of the unique things that we do here at McQueen is provide our clients with a letter which details all of our model inputs and assumptions. This letter also contains various comparisons for 8 of the largest mortgage servicing rights portfolios in the country with a combined balance of about $7 trillion. So every quarter, I have the pleasant task of digging through these public company filings to determine what assumptions they use in their reporting. And since MSRs are considered a level 3 asset, this is very important because we would like to be somewhat in the ballpark of these values. And the first way that we can accomplish this is by looking at the prepayment speeds. So in this chart, as well as the ones that will follow in the next few slides, this is included in our letter, and it shows our client prepayment speeds up at the top for their MSR portfolio against the prepay speeds of the public companies. So notice our client has an overall CPR of 15.3, which is just below the average of 16.5. So we're pretty in line with the market here. And our letter also includes this data in a graph format for comparison purposes. So in this graph, you'll note that the solid line represents the client's prepayment speeds, and the dotted line represents the average public company's prepay speeds. The shaded region in the middle there is the range of the public company speeds. Now you can see that our client is just slightly under the average public company range, and ideally we'd like our clients to be to have their prepay speeds be well within the range of the public company speeds. But if they're not, this may cause us to look into the portfolio a little bit more closely for any anomalies. Along with prepay speeds, we also analyze the discount rate used by public companies for their MSR portfolios. As you can see by this graph, there's really no consensus on the discount rate assumptions. You can see that they range from 5 to about 9.5. So similar to the graph shown for prepayment speeds, you can see here that the average public company discount rate is very much in line with our client's portfolio. Again, as I mentioned, there's a wide range of discount rates used for the public company values. And at McQueen, we analyze the discount rates of the public companies in order to better guide us in the decision-making process. We have a committee that gathers together on a quarterly basis, and we carefully analyze and discuss these assumptions in order to compute an appropriate discount rate for the valuation. The last visual in our letter compares our client's MSR value to the MSR values of the public companies. And as you can see, our client is at about 90 basis points, which is a little bit on the high end of the range. So this did cause us to go in and carefully analyze the portfolio just to ensure accuracy. And as you can see on the graph, the client's value is well above the public company values. And as I mentioned earlier in the presentation, 44% of this portfolio consists of loans that were originated in 2020, which experienced historically low interest rates. So after carefully analyzing the model inputs and assumptions, we have determined this value is reasonable given that these new loans are highly unlikely to prepay. So that is the reason the value is well above the average public company value here. And the previous slides that we looked at were an MSR valuation in a snapshot in time. It shows the pool value as of a report date, and it compares it to the company filings of that same date. Now, McQueen also has this data looking back over 10 years. So we can see that our clients' prepay speeds, represented in green on this graph, are typically very much in line with the range of the public company prepayment speeds. And we also have similar data for our discount rate. Now, over the years, our discount rate has held closely in line with that of the public company's discount rate. And notice in 2020, there was a bit of a decline, and our clients at McQueen have experienced a similar trend for their discount rate as well. Lastly, we also perform comparisons of value for our MSR portfolios against the public company values. You can see a sharp decline in value from 2019 to 2020. And again, this is due to the ramp up of prepay speeds, which stems from the increase in refinancing activity. Currently, we are beginning to see MSR values slowly come up again as borrowers have very little incentive to refinance these loans that they originated in this low interest rate environment.
So we value mortgage servicing rights for clients all over the country. I think it's probably in 40 different states. And by the way, many of you must be on the line because there's lots of people here, and I see lots of states represented, so thank you. And, as we get questions from clients over time, there tends to be, a pattern to these things, right? So before we get into your questions, because I see we have a few, I want to talk about some of the common questions that we see regularly. The very first one is for somebody, and this is coming up more often now, because we have a lot of clients who have either previously retained their mortgage loans and now they don't want to do that because interest rates are so low, or their volume has just picked up so much that they don't want to retain everything that they're originating. So the question comes up, I've never valued my MSRs before. I've either just started, booking MSRs, or I've done this and it has been, immaterial. And really the decision of when to start valuing them is going to be based on materiality, right? Is it a big number, meaning not the unpaid principal balance of the loans, but the value of the MSR asset? The request will typically come from either your auditor or an examiner who starts to look at these things when they get a little bit larger, and they will request that. And then we can work through with you when's the appropriate time to get started. In terms of frequency, we get this question a lot. If you are a publicly traded company, you absolutely need to have your MSRs valued quarterly. We also find that banks regulated by the FDIC will almost always ask you to value these quarterly. But then we have some others. If your pool is in runoff mode, or if it's growing very slowly, you might push it to an annual valuation. So the frequency of valuation is all over the place. It's never less than annually. And in our instance, there's no pools that we value more often than quarterly. So this largely depends on, the growth of your pool and how material it is within your balance sheet. Why did the value go up or down? This question is coming up more and more lately, given what's happening in the interest rate environment, right? The value of MSRs is volatile, just like interest rates are volatile. So the value generally is going to go up or down, most often by changes in the prepay speed. There can be other model assumptions that would drive value up or down, but the makeup of the pool, the average loan size, and specifically the prepay speed is going to drive the value more than anything else. And our model is audited by a third party. We have them come in periodically. They look at the theoretical framework of the model, right? Does it do what it's supposed to do? They also examine very deeply the math within the model to make sure that we are coming up with the, the correct value. This happens periodically, and the audit report is, of course, available to all of our clients. So I know we have some other questions, and we have some time left. So I think, Shelby, you might have some things for us.
Yeah, Jim, actually, this is Charlie. I got a couple we're going to throw in here first, and then Shelby and I will go back and forth on a few. Thank you very much for the information. One of the things that was asked about the presentation or the reporting that we provide, the NCUA has a tendency of liking to see prepayment speed shocks and value shocks. In the reporting that we provide, does it have those types of activities?
We showed one page in here, which was a rather basic analysis of the value in two scenarios, up 200 basis points and down 200 basis points. We also have available a more detailed shock test that shows the value at up and down, 1, 2, 3, 4, 500 basis points. And this is definitely available. We don't have a slide for it today, but our clients will oftentimes use this in their ALM reporting, right? It would be part of your NEV analysis. And so we certainly have that available and can provide that in a report.
Cool. Thank you very much. Appreciate the answer there. All right, Danielle, a question came in to you from Frank here from Tennessee. Why is it important to compare MSR valuation results to large public companies?
Thank you for the question. Yes, so the reason that we have that letter, we provide that letter to our clients along with the MSR valuation is because it has those comparison graphs in terms of the value, the prepayment speeds, and the discount rate. And it's very important to compare our client's value to our client's inputs to the public company inputs, because it is a level 3 asset, which can be difficult to value, and there's really no consensus on those level 3 assets.
Wonderful. It's it's interesting. It's one of the best ways to do some comparisons and make sure we understand where the large entities are, or most of the valuations are. So thank you. All right. We have a question here from Lisa, who is down in Miami, probably partying with all the spring breakers in Miami here. Can I supply you with prepay speed assumptions that are unique to my mortgage pool?
You can certainly do that. This is a little bit of a slippery slope, however, because if you supply us with your own prepay speed assumptions, I like to think of these things in extremes, right? Let's say you provided us with some evidence that your prepay speeds were 0, right? You'd never have a prepay on any loan, right? And we're going to take that for what it is. If we put it directly in the model, the value of your pool would be very high because the cash flow would basically never end. And it would be well above, the value would end up well above the public company average. And so the prepay speeds would fall outside of what we would consider the expected range. So what we typically do when we get these types of requests is we will use some sort of a hybrid method. If you supply us with your prepay speeds and they look reasonable and they are within the public company range, we're perfectly free to use them. But we also want to consider a forward-looking component, right, which is what is done within the model. We can look backwards all day long, but that doesn't necessarily tell us what's going to happen in the future. So we would very likely review those and use some sort of a hybrid method within the model. Great question, though.
Okay, wonderful. Another question that came across was, could you help me figure out which of my mortgages I should be calling on to refinance?
I think we can certainly do that. The data file might have thousands and thousands of line items in it. It's obviously going to have all the appropriate data, right? If it has account numbers in it and so on, it would have interest rates, and we can certainly help identify those.
Thank you. Another question that came in, it says that this entity has to get their MSR performed annually. Is there an ideal time of the year to have this performed? And I'll take a stab at this one and answer. And usually people that receive one-time valuations usually do them towards the end of the year, November or December, for purposes of year-end reporting. That being said, if you're not a calendar end reporter, we'd recommend you do it closer to your year-end financials so you have your year-end financials correct. The other thing too is that the question had a subpart of that we're stating the MSR values are climbing, so should we delay our valuation? And one of the things I think that would be interesting, why not to delay your valuation, is as values go up, we may want to discuss changing your OMSR, or the originated mortgage servicing rate valuation that you're recording. We may want to adjust given the economic environment to ensure that we're capturing the correct values. So something interesting there. All right, one other question did just come in. Jeff here asked us, do you value any other types of servicing rights like commercial loans?
Absolutely. We can value literally any cash flow, right? We have valued commercial servicing rights, consumer servicing rights, car loans, RVs, farm credit loans, farm lending, and all sorts of other things. If it has a cash flow attached to it and you are servicing that loan, we can certainly value it. And we have done lots and lots of those projects, large and small.
And I think as Danielle was telling me the other day, since all automotive people are only talking about electric vehicles, we actually value some pools of Tesla cars, if I remember correctly.
Yep, that is correct. We do have a Tesla car portfolio. We also even have a student loan servicing portfolio in which we value as well.
Wonderful.
So that's another one too.
Well, thank you. All right, we're just about to wrap up. We're going to have I'm really excited about the timing here. And we have a goal here at McQueen Financial that all meetings should last 45 minutes, so everyone has 15 minutes to get prepared for their next meeting or next Zoom call these days that we have. With that, I'd like to thank everyone for joining us. Coming up next year on April 15th, it would have been tax day, but it appears to be May 15th now. But the old tax day, April 15th, we have an industry update, early trends that will be coming out. Then on May 12th, we have an exciting activity. We'll be utilizing ALM for better decisions. And then later in May, on May 20th, we continue our Thursday educational series. And this is Investments and Credit Reviews 101, very similar to this MSR 101 and our ALM 101 we did last month. So with that, I'd like to thank Danielle, and thank you, Jim, for the presentation. Really appreciate it. Thank you all for joining us today. I hope everyone has a wonderful day and a wonderful rest of the week, and looking forward to an incredible April.
Thank you all. We appreciate your time today.
Thank you, everyone.